Welcome to Everyday Economics, the podcast that helps you learn about the economic world happening around you every day. I'm your host, Chris Krug, president of 501c3, nonprofit, nonpartisan Franklin News Foundation. Everyday Economics, a production of America's Talking Network. You can subscribe to all of our podcasts at americastalking.com. To support Everyday Economics, please make your tax-deductible charitable contribution by clicking the link in the show description. We are recording today's episode on Wednesday, November 15th. And joining me, as always, my friend and colleague and partner, Dr. Orphe Divounguy, PhD economist. Dr. O, we got some data in the market on Tuesday. And, I don't know. It's like when the data doesn't shift too much, people don't pay too much attention to it. But I think there's something to this. Consumer Price Index was unchanged in October. However, CPI is up 3.2% on a year-over-year basis. And core CPI increased about 0.2%. but 4.0% on a year-over-year basis. So let's talk about what those numbers mean. I don't know that anybody's life, here on November 15th feels radically different than it did on October 15th. We've had some months where you and I go, and in fact, you and I went to the grocery store together out in Seattle, and I couldn't believe that you were paying, I don't know what it was at the time, like $7 a dozen for eggs.
How about those gas prices? How about those gas prices when I was even fueling up at Costco?
I've been on the West Coast for the better part of the last week, right? So I was up in beautiful Spokane, Washington, and then down in Southern California. And the fuel prices on the West Coast they're staggering. I mean, nobody in Illinois, I'm taping today's show from my home studio in suburban Chicago. Nobody here is thrilled about paying $3.59 a gallon. But if I had to pay $6.79 a gallon, which is what I saw on my last gas station that I passed headed into LAX, or $6.89 a gallon, which was the last gas station that I saw, when I was headed to the airport in Spokane, I think I'd be fit to be tied. I mean, it's literally double.
I know. And you know what's crazy? It's actually come down. Gas prices have come down in the past year. They're part of the disinflation story, and a couple of things are happening, right? So you had the bulk of this past year's disinflation story really came from these easing supply issues, the fact that food prices and gas prices are not increasing as fast, and in some cases have even declined. And so that is the biggest part of the disinflation story in the last year. Yeah. The consumer is finally starting to cool down a little bit. Yes. After this, what I call a summer spending binge.
People were spending money that you felt based on the way that the credit numbers were going that they didn't have.
That's right. You have a situation where the Bureau of Economic Analysis revised their estimate for excess savings, and they revised them up, meaning the people still have quite a bit of savings, but there's a lot of uncertainty around those numbers, right? So that means it could be a little bit more, could be a little bit less. It depends who you're talking to, depends what numbers you're looking at. So we don't really know how much excess savings people have. But one thing we know is that the labor market is cooling. Yes, wage growth is still pretty high, but the labor market is cooling. We also know the unemployment rate has gone up by 50 basis points since April. So the labor market is in fact cooling, and some people are coming in the labor force and taking a little bit longer to find that next job. We also know credit card bills have increased a lot, right? Yes. And so the consumer is, I don't know,
dancing down a fine line, my friend.
That's right. Dancing on a fine line is the way I would put it. But what's interesting is that we had the consumer spending, and we had strong CPI numbers coming in during the summer. And all of a sudden in October, CPI comes in lower than expected.
Yep.
Headline CPI comes in flat, right? And then by the way, retail sales came out today, and people are like, oh, the consumer's slowing down again. That's amazing. Yeah, you're right. It's a good thing. The consumer's back on track. But you know what got the consumer back on track?
Tell me.
That nobody's talking about? The fact that long-term yields soared in October. We went up to 5%. And you know what? Consumer lending is very sensitive to changes in long dated yields, right? You don't have to look too far. You just look at mortgage rates and what happens when mortgage rates go up. When mortgage rates went up in October, the consumer home buying demand slowed more than usual for in October. Credit card interest rates go up. Banks don't want to lend as much. The Fed comes out and says, "Oh, okay, hey guys, tighter financial and credit conditions are likely to cool this economy." Because that's true. Consumer lending is very sensitive to long-term interest rates. Mm-hmm. And when the 10-year goes up to 5%, the market shakes, the banks shakes, the consumer goes nuts, and everything comes back down to earth. But here's the thing. The Fed chair comes out at his last press conference. They're holding rates constant, which is fine. But ultimately, I got to say, the bond market is in charge. Every time the yields on long dated yields fall, guess what we get? We get a small rebound in economic activity. And every time they go up, what happens? We get a slowdown in economic activity. The bond market is now in charge. The Fed has caught up to where it needed to be. And the bond market is in charge. But here's the influence of the Fed on the bond market. The Fed chair comes out and sounds a little bit dovish. Oh my goodness, tighter financial and credit conditions are going to cool down this economy. We got to be a little careful. And we're going to keep weighing the data and deciding whether or not we should hike or we should be done. We'll keep checking. The market interpreted this as a dovish Fed chair. And because they did, yields started coming down again, right? They came down ahead of the jobs report. They came down ahead of this CPI report. Yields started adjusting downwards. And my fear is that as yields adjust downward, the consumer might get a little breather, and that little breather might get things moving again. And so I am not so sure when I hear people, the bond market's pricing in rate cuts next year. I hear all these analysts talking about, we're going to get some rate cuts in the first or second quarter of 2024.
Yes.
That's only as long as yields don't keep coming down. Otherwise, you're going to have some more lending. You're going to have a consumer activity picking up again. And so bottom line is, I think the Fed needs to stay hawkish. Wells Fargo chief economist, I heard yesterday on Yahoo Finance, and he goes, the Fed speakers, because there were a lot of them yesterday, will have to continue to sound hawkish, because the minute that they even telegraph a little rate cut or the idea that they might even be fully done, and that, and the market's starting to, looking at these numbers, sense that the Fed's done. But the minute the market smells that the Fed's cutting rates, yields are going to come down, and we're going to get that 1970s head fake, that thing that nobody wants, that resurging inflation. Because ultimately, consumer finances, yes, they're not as good as they were a few months ago or a year ago, but they're still better than they were in 2019, and they might just have gone back to where they were in 2019, and so or maybe 2018. I think you still have a consumer. You have a consumer that is slowing down, that's getting tighter, where things are crunch, the wallet's getting a little tight. But that consumer, you give them a little leg room, and that consumer will go. We're a consumer nation. We really are. And so that's my take on that. I think the Fed needs to come out sounding hawkish, needs to be very careful, right? Because as soon as the bond market takes over and starts to think, hey, those yields are getting those bonds are getting quite attractive, right? Then then yields are going to start coming down, and that consumer is going to pick up again. And look at the stock market every time yields go down.
I mean, the market in the last 8-9 trading days has been absolutely off the hook.
There you go. There's a lot of money to go around. There's a lot of money to go around still. There's still a lot of money to go around, and it's going to find a way, right? If the Fed lets go, It's going to find out. I don't think the Fed should hike anymore. Fed is done. But I think the Fed should sound hawkish, right? Should not relinquish its authority to the bond market. With fiscal policy where it's at and budget deficits increasing, the bond market could take this thing anywhere it wants. And with the looming government shutdown as well, right? There's no telling where things are going. The economy could slow down, yields could go down, or the bond market could be like, this government's out of control and it's spending too much. And because it's spending too much, we don't want that inflation again. And so what do? We jack up yields. We're selling off those bonds. We don't want them. We don't want that government debt, right? And so if there's already very little appetite for U.S. treasuries to start with. Some people might be jumping back in because prices have fallen so much because of the historic sell-off in bonds. But ultimately, I'm not sure the appetite is really there. And you just got to be careful because, if fiscal policy continues to try to expand this economy, I would say, because basically fiscal policy is loose and still very much expansionary, right? If that continues, the bond market might respond by jacking up those yields. And that could essentially slow down the U.S. economy and push us off the runway. Right now, we're thinking soft landing, but I don't think that's a guarantee. A lot of my friends always say, there's no such thing as a free lunch. We messed around, and now we could end up paying the price. And it's all about, it's the bond market. And the bond market is responding to these conditions. Fiscal policy is still very loose. So let's just sit back and watch what happens next. But I said it here first. We may not be able to avoid this recession if government in Washington, D.C. doesn't get their act under control. And ultimately, if the bond market thinks it's a good idea to buy these bonds again, then the consumer might actually pick up some steam again. So I don't know, man. I don't think we were talking about a soft landing, but in both cases, in both scenarios that I just highlighted, the potential for missing the runway is very much there.
I'll tell you, it sounds like almost the no landing scenario that we talked about at one point over the past couple of months, where this is just perpetuates.
It could be no landing if yields go down, but if investors are sick and tired of Washington D.C. and yields start going up a lot, then you could send this U.S. economy into a recession, right?
Yes, you could.
And so in both cases, you missed the runway, right? The Fed might have done a pretty good job up until now, but the bond market's in the driver's seat, man. And so that's yields start soaring again, you could miss the runway and end up in the sea. And if yields go down, you could get that head fake. The consumer is picking up activity again, and you basically have a no landing scenario. Now, There's a lot of forces at play that will that are acting to be a drag on the consumer, for sure. But they might not be enough if yields start coming down again.
Great unpacking. Well, we went a little bit long, but I think that was well worth it. For Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics and dozens of other quality podcasts at americastalking.com.